Lovely to see you guys here. Thank you for taking the time. And thank you for coming to the Aikya show.
Likewise, Jay. Thank you very much for having us. We're looking forward to this.
Lovely. So here we're trying to learn more about you guys, your journeys, how Morphosis VC came into being, what are you investing into, where do you see the future of VC, what's shifting, right? All the fun stuff, right?
Yes.
And so let's start with you, Amit. If you can tell us a little bit about your journey and how, all the way up to where Morphosis started.
Fantastic. This is a perfect question to start because I love talking about us. We can talk till the cows come home. It's sort of different journeys of the partners, the three partners that came together, but completely different, largely different perspectives, experiences that came together to form Morphosis. But the fun thing was that there was a common theme between us, and that is what really got us together. We'd known each other for quite a bit, over a decade, and but then went away in different experiences. So for me personally, it was, the usual engineer MBA story.
Yep.
So that was me, and then I spent over 2 decades across the UK and Europe and the US, and then a few years in India, then the Middle East, building out a consulting business, which over 6 or 7 years ended up being the largest private equity consulting business in the world. And I was lucky to have that opportunity to work with our global leadership team there. And what that got me to personally was that venture is an amazing place that really drives innovation. But the way venture is done does not really work out for investors in venture. It works out for the founders. It doesn't work out for the investors. Or most often it doesn't. How do we bridge that gap? And the answer in my mind was you take a private equity lens to venture. So that's where we started. That's where I started personally. And then when NM and I and our third partner, Karthik, started talking,
right,
NM's experience was exactly similar, but from a venture perspective, coming into looking at it from a private equity lens, as opposed to me starting from private equity and looking at it from a venture, looking at venture. So that is how we sort of began. But do you want to talk about how we got together?
So personally, I'm an engineering graduate from IIT Roorkee. First job in life was Flipkart. I think great place to work. It spoils you. I remember first day of orientation, Binny and Sachin come in and say, "You guys are smart people. We're not going to tell you what to do. Find an interesting problem to solve. Find somebody in the organization who's sponsoring that problem. Go ahead and solve it." That was the mandate. And once you've had that experience, everything else feels a little stale, to be honest. So I spent 3 years at Flipkart across various roles, from business strategy to data science to finally designing the supply chain for marketplaces. Was quite clear that I want to be part of the early stage ecosystem, probably as a founder. That was the first choice. Also realized that the ideas that I have, I probably don't want to spend the next 10 years of my life doing this. So the next best thing was be associated to as many great individuals and great teams as I can. And the simplest way to do that was investing. So that was the start of that journey. Went to ISB, got my business degree, spent some time at EY in the practice that Amit had built, and then started investing. So been investing since 2017. Longest stint, of course, was with the same family office that Rohinton was also a part of.
Sure.
And learned a lot there about what actually makes sense for LPs, because it was a family office. The lens was a very LP lens into investing, right? So learned a lot about what really matters, probably what's the gaps between the products that funds are offering versus what LPs really want. Had great success there. Portfolio is currently sitting at 10.4x. So it was a great journey. And then the idea was, can we take these learnings out and build a proper fund and a proper AMC doing that?
Excellent. That's I want some of those returns. You don't get those often.
I want some of them too.
Yeah. So I think we need to talk after this.
Yeah, absolutely.
But so phenomenal journeys for both of you. Kudos. And the one thing that's always when I heard about, and Amit and I met in Singapore, is we were talking about your strategy, right? Being you're doing VC, you're doing concentrated versus spray and pray, right? And that was the ring in my ears saying, wait a second, the whole VC business is based on let's do 50 bets, maybe 10% of them are 10x's, and statistics play, and we're good to go with maybe 4 to 5x on the whole portfolio, right? 90% fatality risk. Double down on your winners, the standard sort of Silicon Valley format. And here's Amit on the stage saying, no, that's not going to win. What's going to win is concentrated, dedicated, concentrated bets in early stage, right?
Exactly.
Series A and pre-Series A. And I'm like, wait, I got to talk to this guy because it's a very different story. So walk me through that. Walk me through, Amit, why that strategy? Why do you feel that strategy works? Why has spray and pray not worked in the past? What's shifted?
So, percentage-wise, very few prayers get answered, right? So the pray bit is very difficult to make work if the prayers are not getting answered.
Hmm.
No, but on a serious note, it's called investing on the power law curve.
Yeah.
Right? I'm going to make 100 investments for the sake of argument. I've got, let's say, $100. I'm going to invest $1 million, a dollar in every company.
Yeah.
I'm simplifying it massively. It's not exactly like this. It's a caricature. And what would happen is that, say, 65 of those companies, those investments will go down to zero in the next 4, 5, 6, 7 years.
That's right.
Yeah. So my returns curve, if you're plotting the return on every company, you've got every company marked on the x-axis, you end up with minus 65 initially in the first 5 or 6 years. And then you have the companies that start to make money. And by the time you get to this net zero curve, you've exhausted the vast majority of the companies. Now you're playing with a handful. If you get 2 outliers in that, you're sitting at 4x, 5x. That's your top quartile fund.
That's right.
If not the bottom end of top decile. Right. If you got 1, you're still doing better than median. You look at the data from over 35 years across the world, right? The US is, of course, the oldest venture capital market. But anywhere in the world, you'll find, you take multiple vintages, the median for early stage venture is anywhere between 1.8 and 2.5x over 10 to 12 years. Okay. So think about this. If I'm an LP and I'm investing in the private markets, and the median return I'm going to get is actually a bit lower than a private equity return with much less risk, then why in my right mind would I invest in early stage venture?
Yeah.
And the vast majority of the LPs actually take that view. Having said that, the dispersion in the returns, the spectrum with the top decile, and especially the top end of top decile, is extremely different, because that's where you see maybe 3 or 4 dozen firms across the world, the vast majority of them in the US.
That's right.
A handful of them in Europe, particularly concentrated in Northern Europe. Not very much in India. I guess NM's previous portfolio is probably the only one that gets into double digits, right? Or even gets beyond high single digits. So for that to work, you need to take a different mindset. So we talked earlier about taking a private equity lens.
That's right.
Right?
Yeah.
You invest in, say, anywhere between 15 and 25 companies. We've decided that 20 companies is our sweet spot.
Right.
Your previous portfolio was 21 companies. 20 companies, but you've got to be able to make high conviction investment decisions. And you have to set the system up for that. The sourcing engine, the investment thesis to start with, the pools that you're playing with. For us, it's the India-US axis. You want to de-risk, as much as possible, because the fundamental play here, the first step of this is you're not looking for the outliers. That's not your number one play. You will probably end up with outliers, which is great. And you'll probably end up with more conviction on more outliers in a portfolio like that. But if you execute it right, but you're focused on reducing or mitigating risk at a company level across sourcing, investing, scaling of the companies, and discipline around exits. Right? Those are the 4 critical things that any fund worth its salt needs to be good at.
That's right.
If you're reducing risk at a company level across these four things, the net result is reduction of mortality at the portfolio level. So now the base case is 20 companies, 5 of them do really well, 10 of them are middling players, 5 of them, let's say, go down to 0. So how do you play that? You play that by trying to get whatever you can out of the 5 that go down. Right? Try and save the collar if you're losing your shirt there. Right? Get out of it in the first 3 or 4 years. If there is IP, sell the IP. Do something or the other. Don't just lose all the capital there.
Sure.
The middling 10 companies, figure out at the right point, if in doubt, exit. Right? Exit well before the runway is going to run out. The cash runway for the companies.
Yeah.
And for the top 5 companies, you just keep doubling down. Reserve 50, 60% of the capital in the fund to double down on that. You have asymmetric information. You spent a lot of time with those companies 3, 4, 5, 6 years down the line. You know them really well. You can make a really good case for putting in, if your first check is $1 million, you can make a case for putting in 5 billion, 10 million in follow-on rounds at that, right? And they drive 60 to 70%, maybe up to 80% of the value from the fund. You look at those 4 dozen firms across the world, without exception, these are the firms that produce funds, and they're typically $50 to $200 million funds. You can't really scale this strategy beyond 200 or 250 million.
Right.
The moment you go into an AUM play,
Yeah.
$1 billion AUM,
Yeah.
you get lazy. My management fee is so much. Why do I have to work so hard?
That's true.
Right?
That's what's happening.
So you've got to put the sort of checks and balances in place to take high conviction decisions. You've got the right sort of, comprehensive set of critical capabilities and experiences that are needed to make a good quality investment decision. Not all of those experiences necessarily sit among the GPs. In our case, certainly not the case. But we've got other people working with us who are permanent members of the investment committee, for example, who help us take high conviction investment decisions because they bring perspectives which we haven't had through our experiences. To recognize where your shortcomings are and to fill those shortcomings through people who are really good is one of the decisions that we took earlier. So you've got to make high conviction decisions, then everybody's votes count. Everybody's vote counts, right? So it's voting by consensus.
But that's interesting how what you're saying, right? And the common narrative across, lakhs of VCs. I mean, how many firms exist in the world now?
Tens of thousands.
Tens of thousands, yeah.
And sorry, just to sort of jump in, right? I think the other casualty of spray and pray is the time to liquidity. Because if by definition the top 1%, 2% of your companies are the ones that are returning probably your fund, and then beyond that, you want to hold on to them as much as you can because that's where you're getting the compounding effects. So by definition, those are the ones that you exit last. So the liquidity to LPs takes the longest amount of time with this.
Yeah, that sounds like India. 10 plus 2.
The last 10 years have been quite eye-opening, right?
Very, very, very
10 plus 2 becomes plus 3 plus top of that.
Yeah. So, and then it's hard to even see, I'm an LP, and it's hard to, when you sit with the GP and you look at his portfolio at 12 years and you look at the names, they're actually very good companies.
Exactly.
It's hard to tell him, sell these. You're like, it's taken 12 years to reach. Now is where we go 3x 1 year.
A gold mine. Yeah, exactly.
So, I don't think we can do this. Please give us the extensions.
Yeah.
Because now we'll really monetize, right? But again, we're living in, uncertain times, and sometimes, you have a 2021 where things peak and greed gets better. You still hold on to the jewels. And now we've got Trump right in the house.
Exactly. Right? And I think it's a fascinating opportunity as far as Trump is concerned. There is so much going on, and some people will make a lot of this out of this opportunity.
Yeah, that's true. That's a whole different topic.
Yeah. That's another podcast.
That's another podcast, for sure. But let me come to you. Clearly get the picture. Top firms doing the concentrated PE style VC stuff.
Yeah.
Good to see that coming to India. Good to see that you guys are bringing that knowledge in here. I know there are a few other folks also, but very handful today that are actually, have had success. 7 of them coming out of family offices.
It is happening.
It is happening.
Yes.
But they're very quiet. I think this strategy is why should I tell the world strategy?
Yeah.
Let me just make money and let everyone, fool's paradise, let everyone else chase the spray and pay game, right? Because it seems to be the narrative. And tell me more about, I think the VC world, right? I mean, I see the problems that we had in 2008, problems that we had in 2015, 21, right? That the world is moving quick. Innovation's always clipping, right? Post GFC, post Apple, now post COVID, right? I think the game keeps shifting for VC, and now you've got AI and machine learning and all that fun stuff, right? So help me understand what excites you as as an investment manager going today into this space. I know you've got a few portfolio companies already in the fund. What are the themes you're chasing? What are the themes you're pursuing?
So I think just taking a step back, right? I think as investors, we have that privilege, especially as VC investors, we have that privilege of taking 10, 15-year bets, of what's going to happen 10 years down the line. What's nascent now and it's going to be really, really exploding 10 years down the line. And that's I think a private markets privilege. You can't do that sitting in public markets because your results are visible every day, every second. But from that context, right, I think for us, it's not about getting drawn in by buzzwords or by trends that frankly change every quarter. Something that's hot now may not be hot 6 months down the line. And if you're chasing those noises, then you end up with a lot of dead investments in your portfolio, so to say. So I think for us, the major sort of 10-year themes at this point in time, I think one is cybersecurity and cyber resilience. To your point with what's happening in AI, plus especially with the advances in quantum computing, systems are becoming more and more vulnerable. And for us, that's a 10-year play. And that's across the value chain, right? From identification to protection to remediation or even recovery. And we've made one investment in that side. Now we've got Datamotive in our portfolio, which plays on the recovery side. But that's one very interesting theme for us. Another one that I think is intelligence and automation. I think capabilities of LLMs, as they are called today, they've been improving every, I think, 7 months now. That's the new Moore's law, right? 7 months and it kind of improves 2x. But beyond that as well, right? With compute getting cheaper, with data becoming a lot more accessible, everything around the world is going to be jam-packed with automation, jam-packed with intelligence. So again, for us, it's about playing across the value chain, not just investing in, say a verticalized SaaS that's extremely intelligent and automated for a very specific use case, but also probably at the infra layer, right, where intelligent specialized computing is being designed for specific use cases. So quite interested in those plays as well. But primarily, I think the guiding principle is good companies with good sound business fundamentals and very, very tangible differentiation.
Interesting. If I could just add something to that, if you don't mind. So we focus purely, not predominantly, but purely on B2B tech.
Right.
And there's two simple reasons for that are that, and also, we play on the India-US axis for the vast majority of our portfolio.
That's
two phenomenal. The US has been a great market for a long time. India has emerged really well on the tech scene and economically as well, moving in the right direction. So for companies to have legs in both markets, strong legs that have the potential to multiply, is what we look for. And that's what we try and get conviction about. Now, B2C tech does not scale well internationally. So that's one thing. And, having both India and US plays in our thing helps us de-risk.
That's right.
Right? And it's two opportunities to look after. And some of our companies will do better in the US, others will do better in India, depending on what they're chasing, what their business models are, what their value propositions are. Some may be sort of roughly equal between the two, which also ties into what our exit strategies are going to be for that. But the other bit is that it's rare to find a B2C tech company which can drive accelerated growth without a lot of burn, right? In other words, it's tough to drive high growth and a clear path to profitability in a B2C company at the same time, right?
Yeah.
Whereas for the right kind of B2B tech opportunities, it could be B2B2C, where you get to play in the consumer opportunity, but you do it with much better unit economics.
Sure.
Right?
Sure.
Cost of customer acquisition is a fraction of the equivalent B2C play. Right? And that just makes the whole difference in terms of, so you can drive scaling and path to profitability concurrently.
Right.
And so in that context,
Yeah.
whether it's, some of the deep tech areas that NM was describing, and some of it can be hardware and software combos. Right? Robotics is a critical part of that, intelligence and automation. And there's a lot going on in financial services, right? So we like that. And the SaaS enterprise tech, of course, where the significant opportunity really lies in the US. Then there's the B2B2C business models, where a big part of the opportunity lies in India, because here is where 1.4 billion people live. And often that is focused on Bharat, right? The 98%, not the 2%.
Yeah.
And these are coming up in tier 2, tier 3, tier 4 cities.
Yeah.
Right? Where ticket sizes are small, but volumes are humongous.
Right.
Right. So they need business models that fresh legs who can sort of drive these business models and create that growth, create that value. But they sometimes sort of need some support as well with respect to, building those, scaling those businesses out, right, to be able to drive those returns.
Interesting. Well, great insights. So, NM, coming back to you, and I know, Amit, you touched upon this, which is, are there really credible, businesses being made around Bharat, right? Around that B2B2C 500 million sort of customer piece, right? I'd love to get your thoughts as well.
Right. So I think Bharat is a difficult market to build for. Right. You can't build businesses for Bharat the way you've built for Tier 1 India. And this is an interesting conversation that we were having with one of our portfolio companies that is actually, in fact, building for Bharat, where, the conventional math for Tier 1 is, can you sell something worth ₹1 lakh to 1 lakh customers and you're a 1,000 crore company?
Yeah.
That math needs to be flipped to, can you sell something worth $1,000 to 1 crore customers to become a 1,000 crore company? So there's a 10 to the power 2 sort of delta, both on the price point as well as on the size of the market, right?
That's right.
So by definition, anything that you're building for Bharat has to be public scale, as Nandan Nilekani says, right?
Yeah.
It's not easy to build public scale businesses in India, and some of it has been hampered by just the pure infrastructure available, right? I think now with India Stack around, and we've got a few companies that are building on top of India Stack for the larger population. I think that public level infrastructure is now at a level in certain places where you can build models on top of that. But to summarize, right, I think building for Bharat needs business model innovation. It needs strong cost-effective distribution. And our sense is that the opportunity is massive, right?
Yeah.
It's about building the right models for it. And we're starting to see that come out.
It's a huge underserved market. Yeah. Hugely underserved.
So we're starting to see that come out, right? We've got 2 now in the portfolio.
Okay.
One is ULO, which is a B2B2C education play.
Yeah.
Where they're able to deliver content to your budget private school students, right? So people who pay anywhere between 5,000 to 30,000 rupees a year in their fees.
Yeah.
Right? They're able to deliver content to them at $1,000, $1,500 a year.
Full stack for the tech. For that K-12. For that K-12. Okay. For that subject.
Yeah.
I mean, for that
year.
For that year.
For that year. $1,500 for the year.
Videos.
And they acquire students at $20, 20 rupees a student.
How's that?
They've got a really innovative B2B2C play here.
Sure.
But again,
inspired. The business model is inspired, truly inspired.
So it is. So it is an innovation on the business model side and the ability to bring those customer acquisition costs down, and hence you can serve that. It opens up that entire market, right?
Amit, coming to you for a second.
Yes.
Would love to get your thoughts on what you're seeing from LPs. What are LPs asking you today that maybe they were not asking you 2 years ago, right? Did you see a certain higher level of sophistication from whether you've obviously got an international vehicle, you have a domestic vehicle, Would love to sort of get your thoughts on, what's being asked and are they getting more sophisticated?
I think the answer is simple. 3 letters. DPI.
It was like golden words.
The LPs have been sold a lot of dreams.
Yeah.
And some of those dreams will fructify. It just take much longer than they expected.
That's right. That's right.
It's really that. It's really that. So that, and so they resonate with some of our viewpoints around how we look at exits. And so going back to your earlier question about concentrated versus versus a more diversified portfolio, it is when you're investing in 15 or 20 companies, you can come in very clear-eyed about what your plans A, B, and C are for exit, what the timelines are, what the possible scenarios and outcomes are in terms of returns and stuff like that.
Right.
And you can do that for each company that you're investing in. You can't do that with 70 companies because more than half of them won't exist in 4 or 5 years' time. So you're wasting that time. Plus, you don't have the bandwidth, right? And if you're writing a check every fortnight, it's very difficult to be able to write. But there is no private equity firm worth its salt that goes into a company without being clear-eyed about what the exit options are.
That's right.
Right?
That's right.
So that's another example of taking the private equity lens into early stage venture. But you can do that only with a concentrated portfolio. But then how you structure the exit, how do you, the middle performers, the top performers, the low ones, how does your exit strategy change at a company level, but also, at a package level, right? What roles do secondary, funds play as your potential exit options?
True.
If you need to use that. One of the things that the LPs would love to hear is, for me to look into their eye and say, we will not extend our fund life beyond the time that we are saying. They are looking for shorter fund lives. We do short fund lives.
Yeah.
Our extension periods never go beyond single digits, right? Together with the fund life and the extension period.
Right.
Leave alone 10 plus 2.
Right.
So discipline around exits, whether you're staggering the exits, and if in doubt, get out. Don't look for, again, to Eric's point earlier, right? If you've got those 2 or 3 outliers sitting in your portfolio and you want to keep extending it so that you get that extra 3 exit in the next 3 years.
Yeah.
And I think LPs are a bit tired of that.
Got it.
And every market has been through this. The more developed also have gone through this in the past. There are cycles.
So,
and all of this sort of teaches everybody a lesson, both on the GP side and the LP side, in terms of what works, what doesn't.
Got it. Let's switch focus to the portfolio. Could you talk to us about one portfolio company that maybe you backed at a point when there was an unconventional bet, but the bet paid off?
Yes.
Give us some insights.
I'll pass that on to you because you ran the most interesting one that I can think of.
Yeah, let me do that. So
Sure.
The one that I can think of, and it's probably the best running company in my portfolio, is a company called Mathco.
Okay.
It's a analytics and data science services organization. We wrote them a check late 2018. Conventional wisdom is services is a P play. VCs don't get involved there. It's low margins. Your sort of gross and EBITDA is in the 30-33% and 15-20% range.
Yeah.
There's no operating leverage. It's a body shopping play. All of those things put together, on the face of it, it's a waste of your time. Don't get involved. But I think when I met them, right, the first thing that stood out was fantastic team, right? Hand on heart, I don't think I've met a better team than the 3 of them putting together. But beyond that, right, when you kind of go down to a first principles basis on this company, they're doing high value services. They were billing resources to clients at probably 3x of what a typical services company bills.
Interesting.
right? Gross and EBITDA were orders of magnitude higher, probably 3x of what your typical services company has. They were building assets which were use case specific. So you're building something for one specific client. You can kind of lift and shift and use the same thing for another client. Of course, there's 70% lift and shift, 30% customization, but there is that operating leverage that's being built into the model. So all of these things, when we kind of brought them together, we said, fantastic team, soft SaaS equivalent margins, probably 10% here or there, but SaaS equivalent margins, operating leverage that we have visibility for, we can underwrite this. So we wrote them a check. They continued to do well, and funnily enough, we wrote them the next 4 checks. We didn't let anybody else in.
Oh, wow. That's called conviction.
Which kind of goes back to our philosophy of doubling down on the best performing companies. So wrote them 5 checks in total. Today, it's been roughly about a 7-year holding period now, end of 2018 to 2025, about a 20x outcome on that company, and still going strong.
This is after all the, because of
all the dilution,
all the dilution and all that.
Sure.
Yeah.
Wow.
Yeah. So I think just taking a call on first principles basis kind of worked out.
Interesting. Yeah, because what you just said, services, all the metrics you threw out typically would be, let a PE shop pick it up, right? It's just not enough, not juicy enough for a multiple for a VC firm.
Yeah, we've never been afraid of taking contrarian bets, to be honest. As I said, guiding principle is good companies will make money.
Right.
If the fundamentals are strong. If nobody else wants to pick it up, all the better for us. The valuation is going to be lower.
That's true.
Right. So the other way of saying it is we are just boring people that look for boring companies with solid fundamentals. Our companies are B2B tech companies. They're not household names. They're not sexy investments.
That's right.
We will never have really household name investments in our portfolios. Most people would not have heard the companies.
As long as you make a multiple, who cares?
That's what we are focused on.
You make your money,
Exactly,
right? And you're solving a problem that the world needs. I think that's paramount. One last question, open to either of you, is if you would talk a little bit about how you see the Indian venture space currently, right? Post 21, of course, there's a slowdown. Valuations were very high. Founders, God bless them, had seen some numbers that they could not get over. So then they never raised money until it went to brink. So a lot of growth stage companies, secondaries sort of floating around, which earlier, bankers would come and tell you, I'll get you in, but I want 5%, I want 3%, right? I'm saying, okay, now it's half the valuation. Take as much as you want. Pay me what you feel is appropriate. But just do the deal because I need to make money and everyone needs this capital. And bring 5 friends, please. Right? So it's a very interesting thing. Now that was on the growth stage, but on the early stage, obviously any impact is industry impact. And so things slowed down, and so many funds that I knew where I'm an LP or not even an LP, when you talk to them like, we're going slow. It's like a hangover from a 2-year party. I just all of us worked overtime trying to get more money into certain rounds, and now we're just sort of living with a hangover. We're just taking it easy. We don't need money from you. 10% drawdown this year. That's all.
Yeah.
Right. So we suddenly see this flip. Where do you see it today? Do you feel the founders have gotten smarter? They're more efficient, that froth has come off, or are we still living in a little bit of a frothy state? And either of you can go for it.
I can start and then you can kind of jump in.
Yeah.
So this is kind of my sort of 10,000 feet analysis of this, right? I think what we're seeing now is probably a return to sanity from probably a decade of cheap liquidity, which led to a lot of euphoria, a lot of probably bad decisions as well, or decisions that one wouldn't take unless you had the problem of plenty, right? I think now it's more about investors becoming a lot more discerning, a lot more deliberate, and there's no room for mediocrity left anymore in terms of the quality of the founders, the quality of the companies that are coming out there. So all of those things put together, it's an interesting time where we're seeing the painful medication now, where probably ideas that never should have seen the light of day got capital in are kind of having to go through that, either pivot or shut down and move on to something, fail fast and move on to something new.
Right.
I think from a founder perspective, the good founders have realized this, right? They've also realized that the goalposts have changed. What typically was from a Series A to a Series B, what typically was good enough to raise a Series B is no longer good enough. But the amount that you've raised for a Series A is not going to help you get to Series B metrics either. So what do you do?
Yeah.
And that chasm is only widening, which kind of plays to what you were saying as well. A lot of funds are now being forced to reevaluate and say, okay, we need to preserve a little bit more capital to help our companies. They're good businesses, but they just need to get to the right metrics so that other investors kind of jump in, which sort of plays into our philosophy anyway of keeping a reserve ratio of 50-60%. But I think it's when I don't think we're going to see those crazy frothy times anytime soon, which was, as I said, backed by a decade long of cheap liquidity. But good founders are still getting funded, and this is across the board, right? Whatever stage it is, good companies with good fundamentals, good founders, they are attracting capital, and they are being a lot more capital efficient because they realize that they've got to stretch this dollar a lot longer in terms of the kind of metrics they need to achieve, or they've got to face significant dilution. So founders are getting smarter about that as well.
Good to hear. Some sense prevails. Common sense.
Yeah, I mean, there's 170,000 as of last count. If you, if you agree with the statistics or number of startups and all of that, when liquidity was cheap, the founders that were going to be really successful, who were building fundamentally solid companies, they are still raising. They might be raising at smaller, lower valuations and better terms for the investors at the moment. But a lot of other founders raised, and those companies didn't go very far, especially as the market turned and liquidity became difficult. But the ones that were solid, they're raising now, they were raising then. So overall, there is this rationalization in the service of quality in terms of what is being built, in terms of the kind of investment decisions that are getting made, the efficiency of the companies, as Anand was saying, that are getting built and as they're scaling. And that is going to start showing up in returns for LPs as well.
Got it. Well, good to see sort of things normalize, right? They say everything reverts back to the means.
Well, you see that in the public markets as well, right? Yeah. So it happens. These are cycles. Yeah.
Yeah. Who said? Everyone said, there's a reason why things are trading at 50 times PE. It's the high growth in India. So there's never an end of drinking Kool-Aid.
Exactly right.
Yeah. But this is fantastic. Thank you guys.
Thank you very much
for taking the time, and it's a super pleasure to have you guys with us at the forum, right? And of course, we'll chat more.
Yes, Jay, always a pleasure talking to you. Thank you for having us.
No, this was wonderful. Thanks so much.
Thanks.